Picture a millionaire. Actually picture one, a tailored suit, a European sports car in the driveway, a mansion with a wing nobody uses. Hold on to that image, because for the vast majority of real millionaires in America, none of it is true. The most extensive research ever conducted on American millionaires found something almost nobody expects. Most of them don't live in mansions. Most of them don't drive luxury cars. A lot of them, if you pass them at a hardware store, you'd assume they work there, not that they own 3 of them. By the end of this video, you'll understand 2 completely different paths people take, one toward looking rich, and one toward actually being rich. They rarely overlap. In fact, in a surprising number of cases, they cancel each other out. And once you know how to tell the 2 paths apart, you'll never look at a driveway, a watch, or a vacation photo the same way again. Here's where the confusion starts. Human beings are wired to judge wealth by what they can see. A watch. A car. A zip code. It's the fastest signal available, so the brain defaults to it constantly, without ever asking whether it's accurate. The problem is that spending and wealth aren't the same thing, and one of them can completely disguise the other. Modern life makes this worse, not better. A century ago, you mostly compared yourself to the people on your actual street. Now you compare yourself to a curated highlight reel from thousands of people at once, most of whom are also performing success rather than reporting it. Researchers studying this behavior have described 2 patterns that quietly drive it. One says people measure their own success by comparing themselves to their nearest neighbors and closest relatives, so the moment income rises, so does the perceived need to spend. The other says people who grew up with less feel pressure to look better off than their parents, even if that means a bigger house and a fancier car funded almost entirely by debt. Neither pattern has anything to do with actual net worth. Both are extremely good at destroying it. Researchers who study wealth directly gave the 2 outcomes of these patterns actual names. People who spend heavily to look successful, while their real net worth stays thin, they call under-accumulators of wealth. People who steadily build serious net worth while living well below what they could afford, they call prodigious accumulators of wealth. On paper, both groups can earn the exact same income. In their driveways, their closets, and their bank accounts, they look like they belong to 2 entirely different economic classes. There's an old expression from rural Texas that captures this better than any spreadsheet: big hat, no cattle. It describes a certain kind of rancher who dresses the part, wide hat, big buckle, every visual signal of success, but owns barely any actual livestock. Somewhere down the same road, there's a man in a faded shirt and a 15-year-old truck who owns half the county. Nobody photographs him for a magazine cover. He isn't trying to be photographed. If you walked past both men at a feed store, you'd tip your hat to the wrong one every single time. The under-accumulators tend to share a recognizable pattern once you know what to look for. High income, financed luxury cars instead of owned ones, private school tuition, a country club membership, and almost nothing sitting in savings once the bills clear each month. It isn't that these purchases are irrational. It's that they're funded by future income the person hasn't earned yet, which means the appearance of wealth is often running on a kind of debt finance time delay. The prodigious accumulators run the opposite math: same income, sometimes less, but a large and growing gap between what comes in and what goes out, invested instead of spent, year after unremarkable year. That contrast isn't just folklore. It shows up in real research, over and over. One of the most detailed studies of American millionaires ever conducted found that the typical car buyer in the US spends somewhere around 30% of their net worth on a single vehicle. Actual millionaires spend closer to 1%. Fewer than a quarter of them drive a current year model. Their homes tend to be valued nowhere near what people assume a millionaire house should cost, and close to half of them have lived in that same house for more than 20 years. Here's the part that surprises people most. Roughly 2/3 of American millionaires are self-employed, running businesses that would never make it onto a highlight reel: contracting, distribution, pest control, small manufacturing. Self-employed people make up less than a fifth of the American workforce overall, yet they account for the majority of the country's millionaires. Dull, unglamorous, repeatable businesses, run by people who reinvest instead of showing off, turn out to be one of the most reliable paths to real wealth in the country. A separate, more recent study of over 10,000 American millionaires backs this up from another angle. It found that close to 80% of them never received a single dollar of inheritance. The 5 careers that produced the most millionaires weren't hedge fund managers or celebrities, they were engineers, accountants, teachers, managers, and attorneys. Only about 15% of them ever held a senior leadership title like CEO or CFO. Nearly a third of them never once earned a 6-figure salary, not even in their best year. What they had in common wasn't the size of the paycheck. It was what they did with it. 8 out of 10 consistently invested in their retirement accounts, year after year, whether the market felt good or not. Here's what that formula looks like when it plays out in a real, well-documented life. In a small Vermont town, a man spent nearly 25 years working as a gas station attendant, then another 17 years after that as a part-time janitor at a department store. He drove an old, unremarkable car. He held his coat together with safety pins rather than replace it. Neighbors saw him most mornings at the same diner, ordering the same coffee and the same English muffin with peanut butter, and once even had someone quietly pay his bill for him, assuming he couldn't afford it. When he died in 2014, at 92 years old, his estate turned out to be worth nearly $8 million, built almost entirely from decades of buying and holding ordinary, dividend-paying blue-chip stocks he read about daily in the Wall Street Journal. Even his own stepchildren said they were tremendously surprised. He left most of it to his local library and hospital. In that town, nobody had ever once mistaken him for a millionaire, because nothing about how he lived was designed to be mistaken for anything. This same illusion runs well below the millionaire threshold too. One well-known survey of American homeowners found that roughly 3 in 10 households living in homes worth $300,000 or more had an annual income of $60,000 or less. Sometimes that's an inherited house, or a lucky purchase decades ago. But for a meaningful share of that group, it means a valuable-looking address is being carried by an income that can't realistically cover it, propped up by financing rather than by earnings. The house looks like proof of arrival. The mortgage statement tells a different story. Now flip the picture completely, and look at people who earn enormous incomes fast, the kind of income that looks unmistakably rich from the outside. Professional athletes are the clearest example, because almost nothing about their situation is normal. A career that might last 3 or 4 years, a paycheck that peaks in someone's mid-20s, and a lifestyle built around the assumption that the money will keep arriving on schedule. It doesn't. Multiple studies have tracked what happens to NFL players financially after their careers end, and the numbers are sobering, even after accounting for how the headlines sometimes overstate them. Rigorous academic research following players over more than a decade found that close to 16% filed for bankruptcy within 12 years of retirement, a rate far higher than the general population, despite career earnings most people would consider life-changing. Widely cited industry reporting puts the figure even higher once you count players facing serious financial distress short of outright bankruptcy, and similar patterns have been reported across other professional leagues as well. Multi-million-dollar contracts, and still, a startling share of these athletes end up in real financial trouble within just a few years of the check stopping. It's not that these athletes are careless people. It's that a massive, sudden income spike, arriving with no prior experience managing that kind of money, tends to get treated as permanent. Cars get bought. Houses get bigger. Entourages get paid. None of it looks like a mistake in the moment, because for a few years, the money is genuinely there. The mistake only becomes visible on the other side of retirement, when the income disappears and the spending habits don't. That's the paradox in one sentence: high income photographs well. It doesn't guarantee wealth. Wealth isn't what you earn or what you spend. It's the gap between the two, invested and left alone long enough to grow. Line up everything so far and a single thread runs through all of it. The engineer with the paid-off house. The business owner in the faded shirt. The athlete with the bankruptcy filing. The homeowner whose income can't actually cover the mortgage on paper. None of them are unusual, isolated cases. They're the predictable result of a simple mechanism: money that gets spent to look successful cannot simultaneously be invested to become successful. Every dollar can only do one job. Most people never consciously choose which job they want it to do, so the choice gets made for them, by habit, by comparison, and by whatever the people around them happen to be buying that year. So how do you actually become the person in the faded shirt instead of the person in the oversized hat? It starts with tracking the number that actually matters. Not your income. Not your car. Your net worth, what you own, minus what you owe. Most people can recite their salary down to the dollar and have no idea what their net worth is. You can't manage a number you've never once written down. Build spending decisions around that number instead of around what your neighbors, co-workers, or social feed seem to expect from someone at your income level. A car is transportation, not a scoreboard. A watch tells time whether it costs $40 or $40,000. Every dollar spent trying to look successful is a dollar that can't compound into becoming successful. Treat investing as a habit, not an event. The millionaires in nearly every major study on this topic didn't get there through one brilliant decision. They got there through the same unremarkable decision, repeated for 20 or 30 years without interruption: contribute, reinvest, repeat, and let time do the heavy lifting. Pay off appreciating debt on purpose instead of carrying it by default. A mortgage that gets paid down on schedule turns into an asset. A car payment, a rotating credit balance, or a lease that never ends just turns into rent on a lifestyle you don't actually own yet. And be honest about what status purchases actually buy you. They don't buy security, and they don't buy wealth. They buy a look. Sometimes that's worth it. But it's worth knowing exactly what you're trading for it, instead of mistaking the trade for progress. Finally, give the process time to work, because none of this compounds on a schedule that feels satisfying in the moment. Nobody in these studies became a millionaire in a dramatic single year. It happened in year 22, or 28, or 31. After enough unremarkable repetition stacked on top of each other that the results finally became impossible to ignore. Here's the twist worth sitting with. If you lined up an actual cross-section of American millionaires next to their neighbors, most people couldn't pick out the millionaires. Not because wealth is rare. Because real wealth almost never announces itself. It doesn't need to. It already knows what it is, and it stopped needing an audience a long time ago. The people spending the hardest to look rich are frequently the furthest from actually being rich, and the people building the most wealth are, by design, the easiest to overlook. They're not hiding it on purpose. They simply stopped optimizing for the driveway a long time ago, and started optimizing for the number nobody else can see. Go back to the image you started with, the tailored suit, the European sports car in the driveway, the mansion with the wing nobody uses. Most real millionaires never assembled any of it, on purpose. What they built instead doesn't fit in a driveway, and it was never meant to be photographed. It just steadily outlasts everyone who spent a lifetime trying to look like they already had it.